Hello and welcome to this episode of Investing Not Rocket Science, a non expert series on building and managing an investment portfolio. In the first episode, I defined a basic portfolio framework, and the objective of this investment is to beat inflation and an equity index. The value of this investment is 1 million US dollars, and I'm looking to invest into equities and bonds. And I plan to actively manage this portfolio without the use of leverage, with a time horizon greater than 5 years. And my investment universe are the developed and emerging markets. The ACWI Investable Market Index is the benchmark that I have selected for this portfolio. From episodes 2 to 10, I've added stocks and bonds to this portfolio, and in the last episode, there was a portfolio update. In this episode, I'm going to look at a market update, and there will be a portfolio update, and then I'm going to evaluate a few stocks from the communication sector. By now, most of us have heard of Silicon Valley Bank collapsing last week. It was the 16th largest bank in the US with deposits greater than 160 billion. According to information, this is the largest bank failure since Washington Mutual in the 2008 financial crisis. It is 1 month to date since I began this series. And in this time, the S&P 500 has lost about 6%. The Nasdaq 100 has declined about 4.5%. The Euro stocks has declined about -3%. The Hang Seng about -6.72%. The MSCI World about -5%. Okay, and I can see that most of this has occurred in the last 1 week as a reaction to the Silicon Valley Bank failure. In the same time, bond yields have also fallen, and most of it again has happened last week. The 2-year and the 10-year have declined about 6 to 10%, while the German 10-year yields have declined about 7%. Crude oil has declined about 5%. The gold futures are up in the last 1 month. Okay, so what is the impact of market movements on the portfolio? All right, since the last update, the portfolio has increased in value. The portfolio is now 0.19% up since inception, while the benchmark is down -6.1%. The major change in this portfolio since last week is that fixed income is now leading the gains on the portfolio, while equities are dragging the performance lower. Last week, it was the other way around. So a lot has happened since the SVB failure. Bonds have rallied, equities have fallen. Because this portfolio has a large amount of exposure to fixed income and cash, the volatility that was seen last week in equity markets have been cushioned. And in fact, the portfolio has increased in value while the benchmark has fallen. Okay. So the portfolio continues to outperform the benchmark index. Of course, that is also because there is a large cash component and this portfolio is not fully invested yet. Okay. In this episode, I'm going to look at communication sector. One of the stocks in the sector, which is Google, is already a part of this portfolio. The stocks that I'm looking to evaluate today are Walt Disney, Netflix, Tencent, Meta, Deutsche Telekom, and China Mobile. All right, let's look at company financials. So, China Mobile, Deutsche Telekom, and Meta have revenues between 116 to 129 billion dollars. Netflix is a much smaller company at about 31 billion. Tencent and Walt Disney at about 80 billion US dollars. Okay, in terms of market cap to revenue multiples, China Mobile and Deutsche Telekom look the most attractive with a 1.3 and zero point 0.9 revenue multiples. Meta and Netflix are trading at about 4 times their annual revenues, while Tencent is trading at about 5 times its annual revenue, and Walt Disney at about 2 times its annual revenue. In terms of earnings yield, again, it's China Mobile about 10.7 and Deutsche Telekom at about 6.6. Meta has an earning yield of about 5.8, followed by Netflix at about 3.4 and Tencent about 2.7 and Walt Disney at 2.2. Meta has the highest operating income at about 28.8%, followed by Netflix at about 17.8, Tencent about 18%, and China Mobile at about 14.1%. This tall tower here is the debt equity ratio of Deutsche Telekom. It's at about 312%. It has 3 times its debt than equity. Right. China Mobile has the lowest at about 4.6%. Okay, so Deutsche Telekom and Walt Disney are the only two which have a positive PEG ratio. In terms of PE ratio, again, it's the inverse of the earnings yield. So the lowest PE ratios are China Mobile and Deutsche Telekom. All right, let's look at some trends. In revenue growth for Meta has declined from 47% to about minus 1.1% currently. Okay, and similar decline in Tencent as well. Deutsche Telekom is the only stock here which shows some consistency. However, it has a low growth rate at about 6%. Okay, moving along. In terms of operating margin, 28.8% for Meta, declining trend, however. Netflix is one of the stocks that's looking at some uh, improvement in operating margin. It's moved from 10.2% 5 years ago to about 17.8% currently, which is pretty good. Right. And Deutsche Telekom and China Mobile again consistent at about 11 and 14% operating income margins. Okay. Earnings yield pretty flat. They're pretty stable for all stocks. So no concerns there. Capex is highest for Meta at about 27%, followed by China Mobile at about 22.9%. Meta has pumped out a lot of money on the metaverse, a project which is unlikely to yield revenues, but this capex spend is probably going to eat into future net income when amortization takes place of this capital expense. Unlevered free cash flow, Tencent has the highest unlevered free cash flow, followed by Netflix. And Deutsche Telekom again has a very stable uh, unlevered free cash flow margin at about 11.3%. Okay, that's Deutsche Telekom. It's actually improved over the last 5 years, while China Mobile's free cash flow has dipped. It's fallen to about minus 6.9%. All right. Fair value and upside potential. Okay, on and again, I've looked at the analyst targets for fair value, the upside potential to that, and the discounted cash flow analysis using Investing Pro and the upside potential to that. So, in terms of an average, China Mobile, Netflix, and Meta offer the best upside potential in terms of the average of the two. All right, the analyst targets are always subjective to each analyst. A discounted cash flow method is more objective. That's the reason why I look at these two. Um, However, at the end of this evaluation, none of these stocks give me conviction to add them to the portfolio. Right? So, China Mobile ticks some boxes but has negative free cash flow. Deutsche Telekom ticks some boxes but it has high debt to equity. Meta and Tencent also tick some boxes but are relatively more expensive and have high volatility. So, in terms of portfolio action, there's going to be none at this point in time. This is the chart of of Meta and Tencent, you can see that both stocks have fallen by about 50% from their all-time highs, and they've bounced quite well from their October lows. Meta has almost doubled from below 90 to above 180, and similarly, Tencent has had a good bounce as well since its October lows. All right, so no portfolio action today. After this evaluation, I'm just going to put all of these stocks into the watch list. And in the next few videos this week, I'm going to look at the stocks in the watch list for any opportunities that there may be. Since the market action has been negative, perhaps we could have some buying opportunities. And I'm also going to look at the real estate sector and the metals and mining sector for uh, possible additions to this investment portfolio. Okay, so this is Investing Not Rocket Science, a series on building and managing an investment portfolio. None of this is expert advice. I'm just learning alongside you. Please visit our website for the full disclaimer and terms of use. And you can subscribe to this blog on our website or subscribe to our social media channels. Thank you for watching, and I look forward to seeing you in the next videos.